Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, we're going to talk about how to think like a trader. And this is going to be probably part one of a mini-part series. And the reason is, if you learn how to think properly, that's probably 95% of the battle. The other half, and that's a yogiism, would be to make sure you have a solid methodology and some money management. But your attitude is far more important than your aptitude. Now, I also want to talk about, if I can do it, so can you. We have a lot of examples this week, and rather than tell you about them, we'll just jump right into that. Housekeeping: I do take requests. Makes my job a lot easier knowing what I'm going to cover ahead of time. Also, if I can't cover it in this format, in this venue, which is a little limited, then I can cover it in my Thursday shows, Dave Landry's The Week in Charts, which you can find on my website on Thursday, or at davelandry.com/webinars. If you need to reach me with those requests, or for any other reason, davelandry.com/contact. If you want the slides from this show and all the other shows with patterns and setups and other things like the market timing, go to davelandry.com/StockCharts. And I'll give you enough stuff to keep you busy for a long time, including all my books and PDF format. All right, let's take a look at some mystery charts and the methodology in action. So this is not a mystery charts. No mystery here. I discussed this one last week in the final bar with Dave Keller. He was nice enough to have me on. I really appreciated that. I always enjoy being on his show. It's a great show, by the way. This stock was in a downtrend. It was an IPO. Sometimes IPOs have a pattern, which I call the fly, the die, and then they fly again. And when they go to fly again, the bow tie can be a really good pattern for that. And the reason they probably go through this sort of pattern is because there's some initial excitement for the IPO, but maybe the IPO came public a little too early. Their timing wasn't exactly right. There was a lot of demand for the IPO. But then either the company begins to get its act together, or more likely, and as we're going to talk about today, the public begins to create a demand for the stock. Anyway, you could see that it was in a pretty serious downtrend, and then that downtrend turned to a bit of an uptrend fairly quickly, as evidenced by the bow tie moving averages moving from downtrend proper order, 10 simple less than 20 exponential, and 20 exponential less than 30 exponential, to uptrend proper order, 10 greater than 20 and 20 greater than 30, over a fairly quickly or a fairly short period of time. And this is what I call a tight bow tie. Notice there's very little yellow. Yellow occurs when the moving averages are sort of crossing back and forth and not establishing an uptrend proper order or a downtrend proper order. So, by the way, if all you did was stay long when the market was green, short when the market was red, or out of the market, and also out of the market completely when the market is yellow, you would probably do okay longer term. You do a heck of a lot better than fighting trends, as we're going to talk about in a minute or two. So it was a buy here. We triggered into the position, and so far it really hasn't set the world on fire, but it still looks like a viable setup. Now, here's a mystery chart from the last show. This is SimRush. Here's the parameters. You could see an entry of 1725, stop at 1375, and an IPT of 2075. By the way, anything I show you here is not in hindsight, or at least that's my goal, unless there's a really good example that I need to show you. All of the mystery charts, or I think everyone so far, has come directly from my trading service while it was still live. In other words, like these two down here, live recommendations. And you can see those at davelandry.com/archives if you want a little more information on that. So getting back to SimRush, nice little IPO, nice thrust higher, followed by a fairly deep retracement, and also over a period of a few weeks. Now, normally I wouldn't trade a pullback over a few weeks, or a stock that has pulled back a few weeks in an established issue, but with IPOs, I'm a little bit more lenient, and I have a pattern I call the first deep retracement, which again is simply market takes off and then has a very deep retracement. So putting the parameters I just showed you on the chart, entry here, stop down there. And then so far it's done okay, but it hasn't quite gotten to that initial profit target. Now, I'm going to show you a couple of longer term examples here. But remember, every example that I show you, or every trade that I personally take or personally recommend, my goal is to get a swing trade, and also B, a longer term trend trade out of that. I'm slotted as a swing trader, but I'll stay with a position as long as it moves in my favor. I'm going to show you some in a little while that triggered last fall, and some that even triggered way last summer. So it's possible that I could still be in these stocks for at least a year, and then maybe even longer. We're coming up on the 1 year anniversary, and one of them I'll show you in just 1 second. So anyway, that's the mystery chart. It was SEMrush, S-E-M-R. Now here's another mystery chart from the last show, Click, K-L-I-C. It was in a long-term uptrend. You can see mostly green in the bottom, meaning that the bow ties were in uptrend proper order for most of that uptrend. You can see it did consolidate a little bit, and then they turned yellow, and then back to green again. It made all-time highs, and then look what happened. From green to red fairly quickly, and that completes the bow tie. Now, to complete the setup, the market would have to pull back at least one bar, and as you can see, it's pulled back several bars in here. Nice, good-looking potential short position. Entry here, stop up here, initial profit down here. So let's take a look at what happened. Well, not too much, but the good news is it didn't trigger. So no trigger, no trade. Next. As I've said ad nauseum, especially in the weekend charts, a lot of times I'll get an email, and this is kind of a reoccurring theme. Hey, Dave, I'm down about 50% in that turd you recommended. What should I do? And I'll pull the chart, and it's going straight down for a long, obviously, and I'll think, geez, I would never recommend this. And I tell them, doesn't look like something that I would touch. And we go back and forth a little bit. It's like, well, you recommended it. And I'm like, well, when? And they'll say 6 months ago. And I'll go in and look 6 months ago. I saw a setup. And yeah, it looked like a good setup then, but it never did trigger. And they took the setup anyway. So you'd be surprised how many times you could avoid a losing trade by simply waiting for an entry and following that plan. Now, continuing along the lines of following your trading plan, APG triggered way back last summer, and you could see that for the most part it's had a pretty decent move higher. And then notice that it began to implode. And at this point I'm thinking, ruh-roh, channeling Scooby. On top of that, around that time, the material and construction stocks were beginning to roll over. The overall market had become iffy. Other arguments that one could bring up, for those who could fuse the issue with facts, is that the Fed is printing money, and that means inflation is imminent, and higher rates will kill the M&C stocks. Can't argue with that, right? Now, by the way, the first half of that paragraph is technical analysis. You're looking at the sector, and the sector's weak, and then you're looking at the market, and the market's weak. So that is a negative from a technical analysis standpoint. However, the plan was to trail a stop higher should the stock trend in our favor, which is always the plan, by the way, as opposed to let's just stay with it as long as the M&C stocks do well and the S&P stays above a certain moving average or performs fairly well. Well, that was not the plan. The plan was to stick with the position. So let's see what happens. You can see it came dangerously close to stopping us out, and then it promptly reversed and took off. Will they always reverse above your stop? No. Am I interviewing myself? Yes. Now, this is a hard thing to wrap your head around, but it's really crucial to your success. There's always a reason to exit a stock, or any other market for that matter, and rarely a reason to stay. Now, if you want to look at the statistics of it all, as Greg Morris pointed out, markets only make new highs 4% of the time. Robert Frey, I believe is his name, says that you're in a drawdown about 76% of the time. And I've done complete presentations just on that. More often than not, you're losing money on a trade. It's backing and filling, even on some of your best trades. And there's a lot of neurology and psychology that's involved in that. Not enough time to get in today. But trust me, it's hard, and I don't want to make this look easy, okay? It's hard to hold on a position when they're simply not working. Let's take a look at CPE, which triggered late last fall. And again, you can look at all of these to see that they weren't in hindsight, warts and all, by going to davelandry.com/archives. Notice it went sideways for a while. At this point, you're thinking, this is dead money. Dave's a big trend follower. The trend appears to have ended. Well, we weren't stopped out, so what do we do? Nothing. The stock took off nicely, more than doubled or tripled, and then once again proceeds to trade mostly sideways. At this point, it's really dead money. Well, fortunately, knock on wood, the stock took off again. Now, obviously, they don't always do this, but the point I'm trying to make is more often than not, the best thing to do is to follow your plan. And at this point in time, it's not dead yet. I think I'll go for a walk. ARLP, another one. And this could turn into the mother of all don't micromanage examples. I think AUY, or it was a gold stock or something, from way back when I first started these shows, whenever they were. Go back and watch one of the first episodes. I talked about how the stock had just died out by going sideways, but we weren't stopped out. Well, ARLP might be the mother of all examples. We have already taken partial profits in this one. We have our stop trailed up, which I think is down below the base. And you can check the archives of the service to see what the stop is now. And so far, so good. And it's pushing toward the top of the base. Now, I don't know if it's going to break out or not. And I know you should never hope in trading. Hope, as in birth control, in warfare, is not a plan, is not an option. But let's see what happens. And I borrowed that from Tom McClellan, who got that, I think, from his drill sergeant. So this is kind of really, really dead money. This could be the mother of all dead money examples. But as long as you're not stopped out, there's no reason to exit a market, even if you can make some fairly convincing arguments. But Dave, I thought you were a trend follower. Well, I am a trend follower, but once we switch hats from the short-term trading with a fairly tight stop, and we allow that stop to widen out as the market moves in our favor, then we let things unfold. And of course, they don't always turn out this great. I probably would make a lot more money in my educational business if I didn't spend so much time tempering your expectations. But number one, I could sleep at night. And number two, I feel really good that you have the potential for longer term success if you're a little bit more realistic going in, knowing that there will be ups and there will be downs. Now, I want to begin to talk about how to think like a trader. Over the years, I've been approached by a lot of people and asking me about trading. The first thing I tell them is markets go up and markets go down. And it's interesting because whenever I tell these people this, they look at me like I pooed my pants, as I've said ad nauseum. It's the same look I got many years ago when I went into Starbucks and asked for a cup of coffee. Okay? You have to have a younger person tell you in case you know how to order. I feel like the guy from the Progressive commercial, we can't stop you from becoming your parents. So evidently a cup of coffee is brewed, and what if you want a big one? Well, I want Venti brewed up, room for cream. I think it's something like that. Over the last 20-something years, when I tell them what I do, and they seemed somewhat interested, no one has a problem with markets going up and markets going down. However, when they take a position and the market starts going down, like Bitcoin does, what do they say? Well, it'll come back. I'm in for the long haul. I'm going to buy more while it's cheap, / average down, / dollar cost average. Or even worse, they begin to justify why the slide is not justified. They confuse the issue with facts. Once again, the Fed is printing money. The dollar will get decimated with inflation. Bitcoin will go up. Well, maybe it will eventually, but eventually it could be a long, long time. So maybe the justification or justifications will someday come true. However, someday is an indefinite time in the future. And borrowing a line from Greg Morris, a lot of stuff can happen between now and then. And furthermore, one of the things I want to get into in future shows is the reason that we do trade is because if something doesn't work and stops us out, not go sideways like I just showed and not stop out, we stick with those. But if something doesn't work and stops out, like Bitcoin, for instance, that frees up capital to find other opportunities or possibly short the market that's now going down. And I'll get into that in upcoming presentations more and more. So one thing to realize is traders don't think in terms of justification and themes. They think in terms of charts. And through the charts, the themes find them. Now, keep in mind that these themes are often revealed long after the fact. Many a times I'll get into a stock and it'll be a fantastic stock, and then I'll find out after the fact why that stock was fantastic, or at least the justifications that were used to explain why it went up. So ASO was a setup last November. It was an IPO pullback. And initially it was what I call a pioneer setup, and that's a setup that could occur within the first week of an IPO. Actually, it has to trade at least 1 week. So on day 5 of an IPO, there's a setup I call buy at B, which I've discussed in prior shows. And it was a buy at B, but I couldn't get too excited about it. The range wasn't really that fantastic, and that's why I didn't go after it from a technical standpoint. Now, the other thing was it's a brick-and-mortar retail company, Academy Sports, and I couldn't get excited about it. But Dave, you just said don't confuse issue with facts. Okay, let me back it up a minute. When trading an IPO, a pioneer setup, meaning that you're going to get in an IPO that comes public on Monday, you might get in on Friday's close. Ideally, I like a little bit of excitement to happen there. I did buy a bank a while back, and I prefer, again, the stock to have a little bit of excitement, as I often say. What's a story, fair and glory? I like a little bit of a story behind the stock, and I guess, arguably, you could say that's a theme, but I'm also looking for specific technical things, and if those technical things are really there, I'll go ahead and take the setup, and it was hard for me to take the bank. But I took it, and I can't believe it's one of the best stocks in my portfolio right now. And I've been in it forever. EBR, I think, is the name of that one. Anyway, I have to admit, it was hard for me to take this first deep pullback in ASO. But the pattern was there. It looked pretty good. And that's one unfair advantage I have, in that I do put out a trading service every day. And the way I approach it is, if I see a good-looking setup, I say, okay, Dave, if I don't show my clients that I found this setup and they find this setup later, even if it's after the fact, how am I going to justify that we didn't take this position? So it sort of forces my hand sometimes, and it sort of forces me to do some of these things which are kind of unnatural. Okay, it was hard for me to buy a brick and mortar stock, but the setup was there. Nice uptrend followed by a pullback. So let's take a look at what happened. Nice rally, nice rally, nice rally, a little sideways action. And then now we're up around all-time high. So far, so good. Now, this thing did really well to my amazement, and apparently people were sick of being mostly stuck in their houses. And this inspired them to go out into the great outdoors and do something, anything outside. Now, I probably shouldn't have used this example because to some, they're going to say, well, that was pretty obvious. I thought of that same theme too, and I actually bought Academy, and I did really well too. Well, okay, if you are trading in themes, write down every theme that you think of and trade, and carefully monitor them to see how many of them actually play out. And I'd be willing to bet about 1 in 10 will work. Your odds are much better if you're using a technical setup, something that you've, through empirical research, in other words, that's a fancy way of saying you looked at a lot of charts and you're convinced that this is a good pattern, and you've seen me trade it or someone else trade it, or you traded it yourself, maybe found 100 examples on your own and believe in it, then by all means take that technical pattern, and again, that theme will find you. Now, a while back, several years ago actually, I had a friend visit, and after the obligatory how's the kids and how's work, yada yada, the conversation often turns to the markets. And he said, well, I bought this certain company because I liked the CEO. And I actually met the CEO one time with him, and the guy is a super nice guy. He's the kind of guy you'd want to have a beer with. And then he told me that he bought some more because it seemed low, and then he ended up buying on the way down. And then he said he bought some more because it was cheap, thinking he would flip it out at break even. Now, I drew the big blue arrow in the chart and said, this stock is headed lower. And he goes, no, that's in hindsight. And I said, well, I'll give you your first buy, which may have been way back here. But the rest of your buys, you told me you bought because you thought it was cheap and it seemed low, etc., etc. So that was not in hindsight. And to make matters worse, 1 year later, I asked him about it, and he said, yeah, I bought some more because it was so cheap. Well, the stock at that point was a penny stock, and I went looking for this thing about a month ago to do a presentation, and I couldn't find a chart. So it's delisted or bankrupt or whatever. So he likely has lost all of his money and threw a lot of good money after bad. So again, markets go up, markets go down. Everybody believes that. Nobody has a problem with that until they're in a market that's going down. Traders do not confuse the issue with facts. They don't think in terms of what a market should be doing. They think in terms of what a market is doing. Now, that, by the way, is the definition of fundamental versus technical analysis. Fundamental analysis suggests what a market should do. Technical analysis is what a market is doing. So don't confuse the issue with facts. Traders think in terms of supply and demand. An uptrend means there is demand. Conversely, a downtrend means there is supply. By the way, Mike Moody, years ago at one of the American Association of Professional Technical Analysts meeting, gave a really good speech. And he talked about the fact that stocks don't have in-use value. Now, in-use value means something you could buy and someday use that you would personally use, or maybe somebody else could use, so it would have some sort of in-use value. And he kind of jokingly used the example of toilet paper, which ironically would have actually worked out pretty good, right? So the point was that, let's say toilet paper was really cheap and you bought 1,000 rolls at 10 cents a roll and you had a place to store it, etc., etc. Worst case scenario, you'd have toilet paper for life, or however long it lasts you. If you have women in your house, it probably lasts about 3 weeks, but I digress. Anyway, the point is, stocks do not have in-use value. It's a market based on supply and demand. And as I often quote Tom McClellan's late mother, Marion McClellan, paraphrasing, everyone uses timing in their trading. Some people buy when they have money, some people sell when they need money, and others use far more sophisticated methods. So that buying and selling, whether they have money or need money, creates the supply and the demand. Nothing more, nothing less. Either the market's going up or it's going down. Now, traders think in terms of the greater fool. So if you get into a market, the only reason to ever buy a market is because you think there is a greater fool that will come along and buy that stock away from you. Last summer, the greater fool seemed to be these phone traders, okay? And I would go in and I was trading some of their stocks. And the phone traders, I guess, like the Robin Hood crowd and things like that, these people, a lot of newbies just trading right off their phones. Now, the only reason to ever buy a stock is because you think there's a greater fool. And you've got to question yourself on every trade. You got to ask yourself, am I the greater fool? And you have to be willing to accept that sometimes you might be that greater fool. Anytime I buy a stock, I always ask myself, why would the guy on the other end be selling me that stock? So I think thinking in terms of the greater fool is very important. Now, I've told this many times, but channeling Mark Douglas. Mark Douglas, I have a cassette tape. It probably got tossed out one of the moves. But 30 years ago, I went to a Tellrates seminar, which I think later became a few other things, and then ended up being like the Traders Expo, Money Show, that company. But at this seminar, I was able to get a tape from Mark Douglas's presentation. I wasn't able to attend it live. Anyway, long story endless, he talked about a good salesman versus a bad salesman. A good salesman will make a few sales calls, get rejected one after another, go grab a cup of coffee, and then say, all right, he'll scream, next, grab the phone, and continue on. Because he knows with those few bad calls out the way that he is getting closer and closer and closer to making a sale. A bad salesman will get a few rejections in a row and go drink his lunch. So the way a good trader thinks about the market versus the bad trader is a little bit more of a Churchill versus Einstein. So traders think in terms of going from one failure to another without any loss of enthusiasm. So if you have a valid methodology, you're following that valid methodology, and believe me, it's a lot of introspection, you have to be willing to continue to play along until the tide changes back into your favor. Now, you've got to be really careful at the same time of not becoming the definition of insanity. As Einstein once said, the definition of insanity is doing the same thing over and over again, expecting a different outcome. Something may have changed in you or in the markets, which could render your system invalid. Well, that's all my time. If we're going to pick this up in quite a lot of detail in coming weeks, I have pages and pages of topics that I want to cover. If you need to reach me, again, for follow-up information, davelandry.com/contact. If you want the slides from this presentation and a plethora of other stuff to keep you busy for a long time, again, including all 3 of my books, davelandry.com/StockCharts. I want to thank you for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.